Uh, As you can see, we've got an excellent panel coming up ahead today on demystifying private equity with our friends from Clairvest. Clairvest is an EGSA member company. You might have also seen in the last issue of Powerline that they had an article in that issue. We will share that link. You should have also all received today in an email this presentation. Of course, we'll send out this presentation afterwards as well. And so looking forward to an exciting conversation today. Whether, regardless of where you are, whether you're just looking at this because you want to learn more about the private equity's role in our space, whether you're actively looking for working capital, whether you're thinking about a succession plan, there's going to be something in here for everybody. And of course, we're going to be looking to build on this content. We'll share out this recording as well after this call. We've got two great panelists with our friends from Clairvest with Austin and Mohit, and looking forward to getting through that presentation today. Feel free to ask questions as we go along through the chat function. We've made it so that anybody that wants to ask a question can at any time. We'll have opportunities along the way to ask questions as well, and we'll have opportunities at the end to ask questions. And so just a little bit about EGSA. If you're not familiar with the organization, EGSA is the Electrical Generating Systems Association. It's a 501c6. It's a trade association, about 500 member companies, all in the on-site power generation space, made up of manufacturers like the Big Five, Caterpillar, Kohler, Cummins, Generac, and two Rolls-Royce, lots of other manufacturers, lots of dealer distributors, contractors, integrators, manufacturers, reps, and of course, industry partners like Clairvest as well. And so, if you're not a member, please, do take a look at EGSA and what we do and what we have to offer. We've got two conferences. We've got our spring conference coming up in April in Miami. And would love to see all of you there. We do a lot of other things the trade associations do as far as education, training, and networking as well. And so I think that with that, we can get started. And I'm going to turn it over to Austin and Mohit to introduce themselves.
Appreciate that, Mir, and appreciate the opportunity to speak with some of your members today. As you mentioned, we are a member. We're at the conference. Made some margaritas with Austin, and mine was a little too spicy, but that was quite fun. So yeah, again, happy to be very open. Happy to take any questions. Even if you're not considering private equity, that's fine. I think there's good learnings for you regardless, and that'll be our aim, Austin and I, just to share information, be helpful, and just be a resource for you all. So brief background about ourselves. So myself, Mohit Kansal, I'm a managing director at the Clairvest Group. We'll share more about ourselves as we go, but just to give you a quick snapshot, been around 35 years. And our flavor of private equity, you'll learn that is not all private equity is the same. We're very partner focused. So we're largely investing our money as we are our third party LPs or limited partners. And we always look for folks who have their own money or skin in the game as well. And we're much more about buying into businesses versus buying out, so to speak. So that's the brief commercial on Clairvest. Myself, I've been at Clairvest for about 7 years. Spent some time in consulting as well as another investment firm. And did my MBA in between as well. So that's myself. Austin, do you want to spend a little bit of time on yourself?
Yeah, so I've been at Clairvest since 2017. I have experience in investment banking and infrastructure investing. That infrastructure angle is actually one of the reasons I love the sector. I spent a lot of time looking at electric utilities in North America, and there are lots of problems they're trying to address. They don't have the bandwidth to do them all, which positions members at EGSA to be well positioned. I work with Mohit in all things facility services, but I spend a lot of time in equipment rental, IT services, and various other sectors as well. But thank you for having me.
Great.
And so step one on our presentation is just a background on what is private equity. Private equity is an alternate investment whereby a firm manages money on behalf of silent partners to invest in growing and successful businesses. These silent partners are called limited partners. Typically, they're pension funds, insurance companies, high net worth families. So think of the Canada Pension Board, Canada Pension Plan Investment Board, State of Wisconsin Investment Board, any insurance company with a float, they want to invest in your businesses and they want to invest in growing and successful private businesses, but they don't have the ability to do it by themselves. As such, a private equity firm like Clairvest or any other one you've heard of will raise a private equity fund. This is a limited life fund whereby they raise a pool of capital, invest it in a series of businesses, either in control or minority stakes, which we will explain later on the next slide, with the idea of creating value over a number of years. Each fund is typically between 4 and 6 years. It's going to depend on the private equity firm, but they have lengths up to 10 to 12 years. And throughout this process, the private equity firm, the one raising the money and investing it, will be working with the businesses to create value for all parties, such that when monetization is realized, they can return some of that back to the silent partners that they raised from. Typically, the capital can come in 2 flavors. One is a cash out. So existing shareholders sell their position, they either retire or move on to the next venture, and the private equity firm takes control of the business. Or there is a minority angle, which is what Mo alluded to at Clairvest's view is, whereby we provide capital for growth opportunities, acquisitions, investing in the business, solidifying the balance sheet, and the existing operators stay in control. And so as we touched on that, the different transaction structures have pros and cons, like everything in life. On majority PE recapitalization, this is what most people will think of when they think of private equity. This is a very large firm coming in, buying all or substantially all of the business. Chances are they put in a decent amount of leverage, and then they affect the strategic direction of the business going forward. The good news is that transaction typically results in a full cash out for all parties. And if that's what you want, it's the best path. And so if people are reaching the end of their working life, they don't have a succession plan in place, they're looking to retire, it is a good option for you. The drawbacks are that if you don't fully realize the value for your business that you think the future holds, the rest of that accrues to the private equity fund that's bought the business. And so there's the trade-off. Do you think you're getting full value for your business, or are you leaving some upside on the table? Additionally, there are intangible benefits or intangible drawbacks, such as, does this firm uphold the values that you do? Are they going to manage the business the way that you want it to? And are they going to treat your employees, who you've worked for many years, with the same way that you would? On the opposite side, you have a minority PE investment. This is where a firm would come in for, call it between 30 and 49%, with the idea of backing you, the existing owner, operator, or entrepreneur, to continue driving your strategic direction, with the idea that if you have passive shareholders who are looking to exit, you need capital to do an acquisition, you need capital to build a new location or a new facility, and you just want a partner in the business. That's what they do. The drawbacks of this are you're sharing a little bit of the economics with the private equity firm coming in, but not to the same degree that you are with the majority recapitalization. And then the PE firm you're partnering with will have some governance rights. They're going to want to be able to see the financials once a month. There's going to be quarterly board meetings. They're going to want to make sure that they have some oversight in terms of their investment. The advantages are you remain control, you receive the liquidity that you need, and you have a partner going forward. Both of these are equity investments in your business. The alternative would be a debt investment, which are available through banks or other financial institutions. However, there are drawbacks and advantages with that. Currently, interest rates are quite high, but typically in most normal environments, debt is cheaper. That being said, debt is limited. You have covenants, you can only draw down a certain amount, and it draws on the cash flow of the business if you have to pay back the principal or pay back the interest every year. And so with that, I'll pause here, Mir, if you have any questions on these 2 slides.
Yeah. Do you guys also offer debt financing? Or is that something that a company would have to go to outside channel for?
Typically, what will happen is if we make an investment in the business, we would partner with our friendly lenders to get rates and have a debt financing package put in place. So Clairvest itself wouldn't provide the debt, but we have a number of banks that have been quite generous to us in terms, and we'll put a debt package in that way.
Got it. And then on the minority versus majority, can you start with a minority investment and then change your mind at a later date and say, okay, or after certain goals are achieved and say, I want to now explore a majority recapitalization?
Yes, you can. It will depend on the situation, but it's absolutely possible. And you're actually touching on our case study at the very end. So I'll tease that a little bit ahead of time. When we invested in Right Time, which if people want to skip ahead, it's the last slide of that presentation, or third last. The two partners wanted a financial partner in the business. So they sold us 50% of the business. They took 50% of their cash off the table because they had effectively all of their net worth invested in the business. They wanted to be able to pay off their mortgage, make sure their family had some savings for a rainy day, and then continue driving the business forward with a partner. After a couple of years, and the business was doing quite well, they decided, hey, I want to retire at this point. And so we did a majority PE recapitalization, whereby us and our partners all exited to a new investor. So you can do one and then the other. But I will caution, you can't go majority to minority. And so if you're selling a smaller portion of the economics, then you can later sell a larger portion of the economics, but you can't sell a larger portion and then buy it back.
You're kind of dipping your toe in, then jumping in. You can't jump in and then dip your toe, so to speak.
Of course, and that makes perfect sense. And so, obviously, one of the most important questions here, when you're considering, getting a partnership going with private equity, is, how do you choose the right private equity partner? And obviously, there are both strategic, and structural differences that exist amongst private equity firms. And so, can you talk a little bit about the strategic and structural differences that exist?
So you asked two good questions there, and I'm going to answer them separately. The first one is going to be how do private equity firms differentiate between structural and strategic? And the second one is how do you pick your partner? Structurally, firms can have differences basically in two regards. One is going to be fund life. How long is the fund? What is their strategy for the fund? As well as, and so it could be, do they have a longer duration fund? Are they willing to make an investment for 10 years rather than 2 years? Some private equity firms want to invest and 2 years later sell it out. Some firms want to hold for 6 to 7 years, which is Clairvest strategy. The other one is, what is their philosophy for investing behind businesses? Is it investing for growth to continue driving the business going forward? Is it investing for regional consolidation? Is it investing for a turnaround where maybe the business is struggling a little bit and needs some more expertise? That is more on the strategic side. I would say on the alignment side, there's an important differentiation where certain firms only have a small amount of capital. And so I'm going to scroll back for a second. In this structure, limited partners will invest substantially all of the capital in the fund, with the private equity firm investing some. That creates interesting incentives from the private equity firm. So if the private equity firm invests $1 out of every 100, they're thinking more as an agent rather than a principal. And so really they're managing someone else's money. Some private equity firms invest $30 for every 100, which means they're actually thinking as a principal investor. And chances are that means that they have more alignment with the business, and they're also more heavily motivated to stay alongside their partners and see things through upside and downside. In terms of your second question, in terms of how do you pick a partner, that comes down to what are your expectations for the transaction and for the investment. If you want to fully retire and take all your chips off the table, and you don't care about the intangibles in terms of your employees, the brand recognition, anything, pick the highest valuation. And I'd be the first one to tell you that, because that's what's going to be maximizing for yourself. That being said, if you want somebody who's going to be a partner in your business and is looking for, you're selling a minority of it, and you want somebody to continue growing because you want that second bite of the apple, which is what we call it, I would look for that alignment. Which firms have high investment in their fund? Which firms have success over many funds and many years? Because that shows that they have a track record of being able to create value. And which firms treat their partners right? And so often what you'll do is, as firms are diligencing you, you should diligence them. And so if you're getting into the later stages of an investment with a private equity firm, ask for references. Ask to speak to their previous portfolio company CEOs and see what they say. And if they only give you the 3 ones that have done really well, the 3 home runs, go to their website, pick some of the ones that have done really badly, and ask to speak to those guys. Because you will learn more about somebody when they treat somebody in a stressful situation than when everything's going right.
Excellent feedback. And thank you for answering that. And just one final question. You mentioned, on the structural side, you guys are looking at, 6 to 7 years of engagement. Now, on the strategic side, you mentioned, whether it's regional consolidation, whether it's a turnaround, what is your strategic approach?
So our strategic approach is We are a growth equity firm that invests in businesses that want to continue growing. We have had success in the regional consolidation strategy in select industries. And so what I mean by that is we have quite a robust waste platform whereby we'll invest in one waste operator, and the benefits of consolidating a region. For instance, we used to own a business called County Waste of Virginia. County Waste of Virginia was a residential, commercial, and industrial waste management business in Virginia. Throughout our 5-year investment, that business completed 65 acquisitions to tuck in a number of different routes in the surrounding area, because there are benefits to having dominance in a certain area. You have the ability to send out one truck rather than 3. If you think about other businesses like solar O&M or backup power, service routes can be optimized. You can have more scale from 1 or 2 branches than you would need 5. You might have more rebates, talking back to the purchasing on the supply side. And so that's been really our certain strategy for businesses similar to EGSA members.
Wonderful. And so with that, I'll let you get back to the presentation, but I just want to remind the audience, you guys, you're welcome to use, and girls, the chat function at any point. So if you have a question, feel free to just chat it to us along the way. So back to you guys.
Thank you, Mir. And so why is private equity interested in the standby power business is a holistic question that we asked ourselves, and I'm sure you guys are asking at the same time. It firstly starts with the market, and it starts with the economics of the business. Power disruptions are becoming increasingly more prevalent, and they're becoming longer in duration. So in the US, for the first 3 years of the previous 10, for 2013 through 2015, there were 224 minutes of power outages across the entire US. This gets substantially worse in certain areas. So if you are in the Southeast, Louisiana, Alabama, Florida, there are more power outages than there are in Montana and Wyoming. That being said, holistically across the entire US, power disruption is becoming more and more current. That is because there's aging utility infrastructure, more extreme weather events. The adoption of renewables has more intermittency, and as such, the load carrying capacity of those units is less than that of fossil fuels. And then you have more people consuming more power. All of that creates a very difficult situation for utilities to manage, because they are constrained by affordability and the regulatory construct and how they're going to invest in the grid, which means that commercial and industrial units are becoming more and more mission critical, as well as residential. And so you have increasing penetration of units in the market, and that drives more of the service, maintenance, and repair work, which is more reoccurring and the higher value portion of businesses that service those units. There are a number of private equity-backed businesses in the sector already, but it is relatively small. So it's a few that have some support, but not everyone. So stepping forward, I'm going to pass it to Mohit to talk about the benefits.
Thanks, Austin. So I think we've covered some of this, but I thought I'd spend a few slides on, okay, should I even consider private equity? What's the point of it? And we've laid out some different details here, which I'll go through. So firstly, there's obviously money in the equation, right? So if you bring a private equity firm to the table, they can bring money to your business and to you personally. So they can bring money to shareholders to provide an exit, provide a secondary, as they call it. Or they could provide a primary, which is to invest money in the business and have different uses. So we've laid out a few. So one being accelerating growth. As Austin mentioned, we sometimes do regional consolidation strategies, as will other private equity firms. So as an example, you might have a competitor in your service territory or in the adjacent. It might allow you to gain some synergies, whether it be cost or revenue, or think about going into a new market. That's what capital can do. It can give you that money to go do that. Transitioning ownership. Sometimes this comes up. So if you're in the business and maybe you have a son or daughter who wants to take it over, or your right-hand person who's been supporting you, this can be a way to do that, right? It can provide you some liquidity, give opportunities for others to kind of buy into the business as well. Others, we mentioned reducing debt here. Austin mentioned this as well, but interest rates are very high. We find now some businesses that a year or two ago, when maybe the borrowing rate was a few percentage points versus now 8 or 9, it was a different sort of equation. They had the cash flow to pay that debt or wasn't as burdensome. Now we're seeing it more and more, and bringing private equity to the table can help reduce that and make it more manageable. And then kind of lastly here, just in investing in efficiency. I'm making this up, but maybe you want to make some more capital investments, whether that be new equipment or think about whatever, hiring some more operations personnel or running some more projects around the company. And sorry, the last one here as well is we often see this in situations, especially with folks who have been quite successful with their businesses. So we find that people are, spend all their time in the business and they've done a really good job and they have a lot of wealth, but they find that 95% of their net wealth is in the business. And that's great, but it also creates, risk, right? And if you're running the business a certain way, and 95% of your wealth is in there, that can also mean, you might be running it more in a risk averse way, and bringing a private equity partner could have say, hey, maybe it's not 50% of my net worth, and I'm going to run it more aggressively and try to maximize value. So, okay, there's money at the table. And then as well, thinking beyond money, I think we'll get into this as well, but there's, kind of this idea of there's different flavors of private equity. There's some that are very heavy-handed. So, people who come in quite quickly, bring in their own people, they're doing a lot of stuff. And then there's folks who are more light touch, who don't do much, kind of passive. Depending on your flavor or what you like, there could be different options for what that is. But, it could be as light as just providing support, providing knowledge, or then get more involved with hiring decisions, helping you with finance, and directly helping with some M&A. So there's a lot of reasons to think about private equity, both from a capital standpoint as well as not, and wanted to share some of that background with you. Maybe we move to the next slide here, Austin. We talked about this as well, a little bit about, what you're thinking about in terms of if you want to bring a private equity partner, or what to think about. The first thing I would think about again is what do you want to accomplish, right? So that kind of gets to the control and minority deal. Do you want to sell out completely? Do you want to sell a piece of the business? Do you want to sell nothing? I mean, that's, I think, kind of step one is, okay, what kind of private equity partner do you want? As Austin mentioned as well, partnership, very important, seeking references. I can bring choosing a private equity partner to making a really important hire for your business, right? And I find it funny when times when I talk to people who've taken private equity investment, and I ask them, what did you do when you looked at a private equity partner? I find it odd that they haven't talked about references. They didn't get into details. It's really a two-way street. Think about their incentives, right? Again, if you're hiring a top person, you'd be very critical of, okay, what's their base, what's their bonus, how are they incentivized, right? And you think about, okay, where did they work before? What kind of companies? Like, think about it critically, because that's going to be important. It's going to be a really important part of your business going forward. We talked about alignment of interests, making sure they're aligned properly. Do they know something about the business or not? Are they going to be able to add value? Size of deal versus firm of assets. We talk about this sometimes. You sometimes don't want to be too big for a private equity firm, right? It's kind of like, then you might question, are they going to be able to provide more capital if needed? Are we going to be under too much stress or too much overhead as a result? Conversely, maybe you don't want to be too small. Are they going to care, or are they going to spend time? Thinking about exit horizon. Am I in this for a few years? Am I in this for 10 plus? Thinking about that. Obviously, how do the numbers stack up? Am I getting appropriately rewarded? And then, do they have a good history? So this is just a bit of a list. Again, I encourage people to think quite critically about this and do your homework when thinking about a partner. I think we can jump ahead to the next slide, Austin.
Do we want to pause here for some questions?
Yeah, let me ask a question here. You guys talked about the benefits earlier of private equity. Can you talk a little bit about can you provide some tangible examples of non-monetary benefits that might accrue for a company that's looking to engage with private equity?
Sure. I can think of a few examples. So one is, I guess it depends on the strategy, but for instance, if regional consolidation strategy is a part of the growth strategy that is being undertaken, which is often in private equity, we will often, or a private equity firm will often take a heavy hand in that to help, especially early days. Could be as much as, okay, finding the companies that might be part of that strategy, whether it be going and actually meeting them, finding the lists of them, calling on them, etc., helping negotiate what that looks like, thinking through, okay, what is the offer going to look like? What does a letter of intent look like, etc. Thinking through due diligence, what is, does the financials make sense, etc. So from kind of soup to nuts, the private equity firm can really help with that, because often that is a part of the strategy, and maybe the firm that is partnering with has not had that experience. So that's kind of one example. I could get into others, but I think it depends on the situation, and there are different levers to pull, so to speak.
And then when you start exploring this relationship and you start having these conversations about the benefits as well as the non-tangible benefits, how easy is it if you change your mind to pull out and say, you know what, I'm just not ready right now? Is that a difficult conversation to have with the private equity firm who may have spent some time and effort, and or how is that received?
I would say if you don't feel comfortable, you don't feel comfortable. But until the contract is signed, it's your option to obviously to leave. I would say, like anything, it's good to have checkpoints. It's good to ask your questions upfront. It's good to continue to have a dialogue. Once you are with the private equity firm and actually they are invested in your business, it can be tougher to extract if things are not going well. Or things are going well. I mean, it's good. That's why I'm just saying it's good to be on the same page with the private equity firm. It's good to do your due diligence ahead of time. Once you are kind of in bed, so to speak, with the private equity firm, there are going to be mechanisms for you to, hey, maybe I want to get them out, or I want to look for someone else. But that is usually a tougher thing if you are not on the same page.
Got it. And then, we haven't talked about this. What is the upfront cost for a company looking to engage with a private equity firm? Is the due diligence portion, is that, there's no cost associated with that while you guys are just kind of, deciding whether or not you're going to date? Or, is it, are you paying $500 an hour just to have a conversation with a private equity firm?
Yeah, so it probably won't cost you much until you get to the legal aspect, I would say. I think we do have some slides coming up on preparing for private equity and thinking about what that is. I think it'll be it'll be your time and attention, which, to be honest, might be more important than the financial aspects. But until you get, I would say, to the legal aspects, you're probably not incurring cost, actual kind of out-of-pocket cost. But your time, your team's time is obviously worth something. But depending how you're doing it, and if you bring advisors on or not, in our experience, it's usually when the lawyers get involved that the costs start really racking up for the transaction. So when we undertake due diligence and whatnot, we try to make sure that everyone's kind of on the same page before we get to a point where people are starting to spend significant costs, time as well, because we just don't want to be, wasting people's time and money, because that would be a painful experience.
Got it. But so what you're telling me is that the billing doesn't start the minute you make the phone call.
I mean, I don't, it's not like we bill to the company, so Austin's and my time doesn't cost anything. But if you bring third parties to the picture, that's when it will cost some money. And typically, the deal doesn't go ahead, people pay their own bills. If the deal does go ahead, it's usually kind of everyone's happy, and that's kind of absorbed into the transaction, those types of fees.
Yeah, attorneys love to get paid, and we like to charge in 6-minute increments. And so you're telling me that's not the same here. Okay, I don't want to beat a dead horse. So moving on.
Yeah, sure. Yeah, so preparing for a transaction. So as I mentioned, I think this has value if you're looking to undertake a transaction or not. And I'll leave folks to kind of read the different numbers. I always kind of think about three things when thinking about, okay, do I want to think about a transaction? How does that look? The first thing is kind of, maybe simple, but kind of getting your house in order, making sure your financials are accurate, they're done timely. Are your contracts digitized? Are they in place? Do you know where they are? Making sure your employment agreements are in place and are just making sure from like a financial and legal standpoint, all that information is available, ready to pull, and is accurate. That will be the first set of questions you get during due diligence, and making sure your house is in order and that information is readily available. As you see there's pieces around if you can get an audit, that's great. Making maybe perhaps reviewed, using third parties for that. And as I said, I think that's helpful even if you're not undertaking private equity or not, but just making sure you have your house in order. The second thing I would say is, okay, being able to articulate a strategy or having a clear strategy in place. I assume if you've grown your business to where it is today, you probably have a pretty good strategy in place, but being able to articulate that, what's the growth look like? How are you going to achieve that? You might need to do some soul searching, have some conversations, but articulating that growth strategy, because most private equity firms are going to say, okay, what's your growth plan? How are we going to achieve that? And then the third thing, which is kind of tied to it, is making sure you have the right team in place. Do you have the right lieutenants around the table? Do you have the right management structure in place? Because any private equity firm is going to say, okay, first question is, what's your growth plan? What do you want to achieve? Second question is going to be, okay, do you have the backup to prove that? You have the financials and whatnot. And then the third thing is going to be, do you have the team to go execute that? So that's the way I kind of think about it. What's your strategy? Do you have the proof points to suggest that is achievable? And then third, do you have the team to achieve it? So, these are a bit of a laundry list here, but and again, I encourage you, if you're not even interested in private equity, to think about these things. I think it's just healthy for a business in general. I'll go to the next page, Austin. Gave you a nice chart here. We were joking before, should we give you a proper Gantt chart that spans over many pages? But here's the kind of high level view on what it is. And of course, no deal has progressed the same, but we thought at least give you the highlights. Typically, there's an initial meeting, surprise, surprise, where you meet the private equity firm, get to know each other, understand their strategy, they understand your strategy. Often as we've talked about, make sure there's a good fit, you get along. Life is short, making sure you get along with people. Then we'll often move to due diligence. Often an NDA is exchanged at that point, making sure confidential information is properly dealt with. And then, maybe a short data request list. What does your historical financials look like? What's your strategy? Do you have a budget? Any projections? Who are your key customers? Stuff like that, to allow kind of preliminary due diligence, to allow private equity firm to get a view that leads to negotiations in terms of what a deal could look like, to get an agreement in principle or a letter of intent. So the goal, in the initial kind of 3-4 steps, there's kind of a dating process a little bit. What's your strategy? What are you trying to achieve? What does your business look like? And you're doing some due diligence on the private equity firm. What are your plans for the business? What do you want to do? And that kind of gets consummated in what I would say is kind of the first big milestone of the deal, being the letter of intent. Or really, it's our letter of intents are actually used a bit longer because we like to be transparent, but it can be anything from a little as 1 page to maybe 5 or 6 pages. That kind of lays out the key constructs of a deal. What's the price? How is it going to be structured? Minority, majority? Is it going to be in common equity, preferred equity? I don't want to get too technical, but what's governance going to look like? What rights do you have? They have. So it's an important document. You should definitely get a lawyer to review that if you have a letter of intent. And that is going to be kind of the guideposts of a transaction or what it looks like. From that standpoint, it's typically, I would say, maybe a 30, 60-day sprint, so to speak, to kind of confirm a lot of what's been learned in the first 3 to 4 steps. And that's typically when, Mira, you kind of mentioned, that's typically when the private equity firm and maybe the target or the company are spending more money. That's when you're getting maybe third-party accountants involved, you're getting lawyers involved, maybe consultants, et cetera, to kind of validate everything that's been represented. That leads to actually drafting agreements, as I mentioned there on kind of the second last step. Key documents being an acquisition agreement or purchase and sale, which governs how is the transaction happening. What are you buying? What are you representing? What does the dollars and cents look like? And then a second big one being the shareholders agreement, which we put a lot of value in, but how is that going to be governed thereafter? So if you're not doing a full sell and you're selling where 30, 50, 70%, what rights do you have? What rights does the private equity firm have? Go forward. And then lastly, hopefully a big party around the final documentation and closing, sign the documents, and that's when the money would flow. There might be a gap between quote unquote signing and closing if there's regulatory approvals involved and whatnot. If it's a bigger transaction, that might be the case. Sometimes there's other things that come up, whether you need consents from customers, landlords, etc. But I think if you have good lawyers, wouldn't be too worried about that. It's more typically more just kind of happening at that point, and it's more procedural versus kind of substantive. So kind of a long process. I'd say NDN maybe if things are going well, maybe 90 days. We kind of say 3 months. Could be longer, could be shorter, but that kind of gives you a view end to end. Austin, anything you wanted to maybe mention that I might have missed, or you think I captured the key points?
No, I think you captured the key points. I would say the LOI, as Moet talked about, you can get there with hopefully less effort than post LOI, but that should be a great guidepost for, is this a transaction that you want to do or not want to do? And review it carefully. Some people will be very transparent in their LOI and some people will not. And if some people hand you a 1-page LOI and just says, hey, valuation is X and this is the cash out, I would have your spidey senses or the hairs in the back of your neck prickle up, because you're going to want to know more details than that. And because at that point, you're teeing up third-party costs. And at that point, you're starting to get serious in your dating relationship. Not quite exclusive or married, but you're getting into that point. And as such, make sure you understand everything that's happening at that point. And the partner you're partnering with should be transparent in that.
Yeah, it's a good analogy. You're kind of dating before LOI, and then you're kind of going steady, so to speak, and then you're getting married. But I fully agree. I would say it's better to put more in the LOI versus less. Like, just get it all out there, be transparent, because you don't want to waste time or money. And again, transparency is hopefully going to be the bedrock of a relationship going forward if you're actually, working with that private equity firm going forward. So I think we're going to pause for questions. Yeah, let's pause for questions if Mira or anyone else. And again, feel free to put some questions in the chat if you haven't.
So, you just briefly mentioned this, Mohit, as far as the time horizon, right? So, and I think that a lot of people think, if I do this, I'm in for a year or 2 years of misery, and I'm not sure how it's going to turn out at the end. But, I think you said, it's more like a 60 to 90 day process, did I hear you correctly?
I would say if things are going well, it's probably 3 months from first meeting, but I would say sometimes it's longer. I would call it 3 to 6 months if you're kind of doing something, but it's hard for me to commit to times because often what I find is, in my experiences, folks are not necessarily ready, things might drag on, but if you feel like you're ready and you're having good conversations, it could be kind of a 3 to 6 month process. I would say from a letter of intent being signed, then it is more of a sprint and kind of everything's kind of been figured out. Then that's probably a 2 month or so process. So, I don't love saying it depends, but if you're organized, have your house in order, it's probably around a 3 to 6 month process end to end.
From initial meeting to final documentation.
Correct. Yeah.
That's pretty awesome. And obviously, I think that's probably another consideration that a company might want to consider as far as, how quickly can this potential private equity partner work through this. If it's going to take them a year or 18 months or whatever, then, they may not have the sophistication or the time for you, right? And so that could be another indicator. But once the investment is made, what does the relationship typically look like?
Mo, I could take this one.
Yeah, go.
I would say it depends on the firm, but you're going to have 2 barbells. You have a type of firm who will attend the quarterly board meetings, receive the financials, and be very light touch. That being said, they will not provide a lot of value in terms of help driving the business. The opposite side of that is going to be a firm that has a suite of operating partners, has management executives that they drop into the business, and effectively is going to take control. And so from that point, you have touch points every 90 days to touch points basically every day. Speaking from Clairvest example, we are somewhere in between. Our strategy is to back existing owner operators, but we want to be your partners in the transaction. And so typically there will be a call once a week, once every 2 weeks to discuss the business, what's going on, a more detailed call once a month to discuss the financials, and then an in-person meeting for a day or 2 on the quarterly board meetings to discuss the strategic vision, how's the business progressing, what areas need investing in, where are the opportunities going forward. All of that is caveated with one exception, which is if there's a big initiative in place, Clairvest effectively becomes an in-person or a outsourced corporate development team. And so there's been situations before where Moat and I have worked with the company. They were looking at a huge, effectively reorganization of their sales structure. They wanted to change the comp. They wanted to bring in a new head of sales. And we were on the phone with the individuals there every day, twice a day, for a period of a couple months, trying to provide our assistance that we can so that it's a smooth transition and a well-implemented initiative. And so that is kind of the cadence. That should be understood before you go in. So as the company, as an owner operator, make sure you understand what that is and make sure you're getting the type of partner that you want. I would say that if everything's going swimmingly, chances are the touch points become a little less frequent, because a call could be, hey, financials are great. Year-over-year growth is 10%. We're looking fantastic. We really want to go execute these things. Clairvest, can you go help us with that? But if you're really trying to do something and drive towards an initiative together, that's when things become a bit more collaborative and it's bounced back and forth every day, every week.
So let's talk a little bit more about that, and dive a little bit deeper into that. Obviously there are differences at play, whether you're looking at a minority scenario versus a majority recapitalization, as far as the assistance or help that you guys will provide when it comes to growth. If you're providing growth equity, how is it that you can help? The company might just say, hey, I know exactly what to do. I just need the money to do it. In which case you guys say, great, go do it. But if it's something more than that, right? I need help with my, strategic planning. I need help with establishing key relationships. I need help with supply chain issue. I need help with lowering my costs or my expenses. What assistance do you guys provide, or would a good private equity firm provide on that? Is it just putting out experts on the staff, or what does that look like?
So it can be a multitude of things, and this is actually a great transition. So I'll bring up the case study at the end because this is the perfect example. First would be an assessment of what's going on and where it needs to be addressed. And so if there's not enough leads, and as such you have a great sales team that can convert a lead into an actual sales and you can maintain the customer, fantastic. We'll focus on the leads aspect of it. But if the aspect is customers are churning, you can't maintain service contracts because people aren't happy with the actual contracts and the level of service you're going, we would analyze that business, figure out what needs to be done, and then either make the requisite strategy adjustments or HR adjustments to make sure it happens. And so a great example of this is something called Right Time. Right Time is a residential HVAC contractor based in Toronto. They did replacement of HVAC units, heating, ventilation, air conditioning, in effectively the GTA and throughout Canada, but Ontario was their home base. It was owned by 2 partners plus a small smattering of other inactive shareholders, but they were keen on continuing to drive the business. They were fantastic, and I mean fantastic in every letter of the word, at closing a sale when they got in the door. They were not great at generating leads so they could get their salespeople in the door to close that sale. And that's what we really focused on throughout our transaction. And so through it, we became in-house digital marketing experts. Previously, they were looking at advertising on the back of the Sunday paper because they thought that was the best way to spend their marketing dollars. And they were quite frugal with their marketing budget. We did a lot of analysis to show them that no, that digital leads are fantastic for your business. There's a higher ROI for pursuing them. It gets more of your salespeople in touches with the humans or in touches with people at the house to make that sale. And so we took their marketing budget and tripled it, focused it on more areas that had higher ROI or higher efficacy, and took the amount of leads they were getting and effectively increased it by 50%. On top of that, we hired an internal head of marketing that took over that responsibility from Clairvest to make it more sustainable on a go-forward basis. And then we pursued the corporate development strategy of consolidating the region. Clairvest sourced, diligenced, did the legal documentation, and helped integrate the businesses with the existing footprint so that the business could continue implementing its great success with its branches in more regions. Did that kind of answer your question, Amir?
Yeah, and I'm happy I was able to set you up for the slide. I wasn't intending to, but yeah, we answered the question, and that was a smooth transition.
I was trying to give you a specific, and so this is the best way to give you a specific.
Wonderful.
I'm happy to spend more time on Right Time, but if there's any more questions on the transaction process, I'm happy to spend more time there as well. So if anyone has questions, please feel free to ask.
Maybe let's talk a little bit more about who Clairvest is, right? Obviously, there's lots of private equity companies out there. You guys are not a mom and pop. You're not fly by night. You're pretty established in this space. And so, could you talk a little bit more about Clairvest as a whole?
Yeah, so Clairvest is a private equity firm based in Toronto, Canada. If you can't tell by our accent, we were founded in 1987 by a group of entrepreneurs who had built successful businesses, but they didn't have access to capital when they were trying to scale. And so they wanted to create a firm that was the type of institutional capital they would have wanted when they were in their developmental journey. And so our motto since then has always been by entrepreneurs for entrepreneurs. And that really affects our strategy. Our strategy is to partner with and support existing entrepreneurs and owner operators as they implement their strategy. And so with that, we've been doing that strategy for 35 years. We are on our 7th fund. Our latest fund was 1.2 billion US. We have about 4 billion Canadian under management. And it's been exclusively focused on partnerships. And one of the things that we like to do to hit this point home is we have partners. We invested with them. We supported them. They grew their business substantially. And they're now actually on our board of directors. And so they're Moet and I's bosses, tell us the strategic direction of how we should be continuing the business. And at the same time, we have partnered with the same entrepreneurs multiple times. And so we have a family in the Northeast called the Winters family. I believe we've done 3 acquisitions or 3 investments with them. We have a family called Scott Earl is an entrepreneur. We've invested with him twice. And we really view that as the best stamp of approval because it shows in good times and bad times, entrepreneurs liking working with us as we are friendly and supportive and not the command and control type private equity firm that you might get from New York bankers in pinstripe suits. Throughout our 35 years of history, we've been successful. Our IRR to date is 25%, and it's been a 4.2 times MOIC. What that math translates to is that we typically hold our investments longer than most private equity firms. As we scroll forward, our average hold period is about 6 years, rather than 3 to 4, which is most other private equity firms. We prefer to invest behind owner operators and existing entrepreneurs in minority positions or slight majority, if that's how the cap table works. But really, we are partnered with them. And one of the things that really hits that point home is that we are the largest investor in our fund. And so if we make an investment, it's not us managing other people's money. It's us managing our own money. Effectively, all of my net worth is in Clairvest. Effectively, all of Mohit's net worth is in Clairvest. And so we were really thinking about being a principal and partnering with the business together.
Excellent.
And, one thing I would just add, Austin, if that's the case, we have our story and we're proud of our story, but I would, again, to do your homework, and I feel, unfortunately, there's a lot of noise in the sector, and I'm sure the people on this call are getting emails and phone calls, but just do your homework again and understand the story. Are they credible? Are they someone with a long history? And again, we're proud of ours, but there's others out there as well. Again, just do your homework. And I'm finding every day there's just more noise in the industry. People are just startups or haven't done this for a long time. So again, do your due diligence and do some of the work and understand what's really the signal from the noise, so to speak.
We have a question from the audience. Jim Sanders with Merkel. Jim is asking, at what revenue size does a transaction make sense?
It honestly doesn't matter. It will matter for the fund in question, as Mohit has talked about. You don't want to be too big that they can't properly support you. You don't want to be too small that you don't get your needed support or the support that you deserve as a partner with them. So I would say if you're growing the business substantially, you have positive profitability, but that's not necessarily required as long as you have a path to get there. You can seek financial partners, but just make sure that whatever size you are at, you have a financial partner that matches that. And so you don't want to be, what I'll say, a $2 business and have KKR coming in. That being said, you don't want to be a $6 billion business and have a small family office that has $100 as your investor, because there's just a misalignment there. Just make sure that you're partner with someone who has the same scale and the same desires as you.
Excellent. And we talked about this a bit briefly earlier. You mentioned the role of limited partners, in a private equity transaction. Can you talk a little bit more about the role of limited partners in this in the transaction?
Yeah, so they're effectively silent investors. They don't have much role besides providing the capital. They are typically insurance companies or pension funds or institutions like that, that want exposure to growing and profitable private businesses. But because they don't have the experience or the expertise in-house to do it, they hire a private equity firm to manage that. Contractually, they've entered into a contract with the private equity firm in question, so Clairvest for an example, such that if Clairvest was to make an investment, we would call upon the limited partners to make their required capital investment, and we would all enter the investment together to the fund. Because they have the contract with Clairvest, it's less so discretionary at that point. It's Clairvest has the effectively right to invest or not invest on their behalf.
I was gonna say, I think that's a key point, Austin, because again, there's some private equity firms that don't have kind of the silent partners in the background, and they'll go on a deal by deal basis and could create risk or frankly a waste of time for an entrepreneur. So again, as far as your homework, do you have the money? Is it available for you if you need it? Rather than kind of creating an issue and creating, a waste of time, so to speak. But yeah.
We've got another question, thank you guys, from Eric Lavin. Eric is asking, can you give an example of typical standby generator configuration through a program like this? What is this site required to provide in finance? What is the long-term payback for the investor? Can you guys answer that?
I'll try my best. I'm not sure I understand the full details of the question.
Yeah, and Eric, maybe you can clarify a little bit, because I'm not sure either what you mean by an example of a typical standby generator configuration through a program like this. You're talking about a typical company and how it might set up. So Eric, maybe you can clarify a bit, but Austin, why don't you take a stab at it?
Yeah, so I'll say what we're referring to here is Clairvest investing in the actual organization through equity investment. So a perfect example is, say you have a business worth $100. The existing owner operator has $60 invested. There might be $40 from passive shareholders. Clairvest could cash out the passive shareholders, give partial liquidity to the CEO or the existing owner operator so that they're 50-50 partners going forward, and continue exiting the business plan. If this question is referring to financing of the individual units, that is not Clairvest. We invest in the company at the top. However, we have partners, and we have done this for our residential HVAC business, where we would find ways to have financing implemented in the business, because that could be a key pillar of strategic growth going forward. So rather than the customer paying $10,000, $15,000 up front for a residential unit, maybe have them pay $26 a month. And we would have that securitized off on the backside so that you can grow faster and there's more flexibility for customers coming forward.
So if I got that correctly, then what we're talking about, of course, is that the investment is made in the company. It's not made in a particular project. It's not made. It's not made specifically for, hey, I need to acquire some equipment, for my next project. It's more, we'll invest in the business, and then of course, as part of that, it's going to give you working capital to do all those things, right? That you may want to do.
Yeah, and so if we wanted to invest in a business and say that business wanted to make an acquisition or buy the equipment, we could do that where instead of cashing out shareholders, we provide capital to the existing management team, and then they use that cash in ways that they think best benefits the business. And so an example would be if you're a business in, I'll pick a state, Florida, and say you have a competitor nearby and you want to acquire that business, but you don't have the capital to do it. Clairvest could invest in you. You could take that capital and then go subsequently buy that business. And as such, the entire business gets bigger for all parties. And then you would continue on that strategic path in terms of growing and then realizing the cost synergies on that.
Of course, and then of course, the debt equity thing that we talked about earlier, as well as another the third leg of the stool, that could help play a role, in something like this if you're looking to just take out a loan, right, for a smaller purpose, and you're not looking for a minority or a majority recap.
Absolutely. If you need $2 million for a bunch of working capital and some equipment, you could do that with debt, depending on the size of your business. But if you need 20, 40, that is harder to get to unless you are of substantial size. And even if you do need 20 or 40, the terms could be different with having a partner versus not having a partner. But I encourage you to explore both of those depending on your needs.
Wonderful. And so guys, we've got 5 minutes left, and I want to make sure that you get a chance to share your contact information, because a lot of people are obviously understandably reluctant to discuss these topics in person. Don't want to show their hands, and so we'll make sure that they get a chance to follow up with you guys. And I know that you guys would be more than welcoming to answer any questions. But the last question that I want to ask you, with the time remaining, what are the types of things that might derail investment from a private equity firm, right? A lot of people are just so afraid to get started that they don't get started because they might think that they've got a skeleton in their closet, which is not actually a skeleton or something like that. And so, what are the types of things that might derail a private equity investment?
I think it comes down to, as Mo spoke about earlier, having your house in order. Anything that could derail a project would be something that pops out of the woodwork that is unexpected. And so if you have, for lack of a better expression, a skeleton in the closet, be transparent about it up front. Because a lot of the times if you bring it up, hey, we used to have a great service contract with these 3 commercial customers, they churned because they no longer need it, they have the in-house expertise. Just address it. It's a part of business, there's ups and downs. And so together we can get through this. What derails it is if something unexpected happens. If there are hidden lawsuits, for example, if you don't have the right contracts in place to prove that you own your shares, that you have a business worth operating, that is really where things have the ability to derail. As you're going through, it's not a long process, 3 to 6 months if everything is there, but it really comes down to having everything ready. Often what can derail a process is if you start it and then you have to stop to collect everything, and then you start it and you have to stop to collect everything. So it's worth taking a time prior to engaging transaction just to get your situation in order and have all of the contracts, the financials, and everything you need ready.
Can you guys provide like a checklist or something for our members that might, after this call that they might consider as far as getting your house in order type checklist? I think that would be helpful. And so with that, I think we've only got 3 minutes left. If anybody has any final questions that they'd like to ask, please do so. And if there's anything you guys would like to share, of course, here's your contact information. Please do that as well. And again, you all received this presentation already today. We'll send it out again along with the recording, along with Mohit and Austin's contact information. I want to take a minute to thank you both for an awesome presentation. I know we could have spent 40 hours on this, because you can go so deep into any particular aspect of this. And I think that you guys did a fantastic job putting together a very high level presentation that touches upon the most salient points of it. And so thank you both for that. Any final thoughts from you or any final questions from the members?
Final thoughts from us would be, if anyone has any questions on materials here that we didn't cover, feel free to reach out. Mohit and I are friendly individuals. We're happy to chat. And it doesn't have to be, hey, we're engaging or we're starting to date. We're happy just to chat and say, this is a great fit. This is not a great fit. Perhaps you should consider this. Or even if you're in a process somewhere else, we can chat about, make sure you think about these things. And so
happy to bounce ideas off of us. Yeah, feel free to reach out, guys.
Use this as a resource, and we're happy to have conversations.
And then you guys will be at the spring conference as well, so they'll get to, if they didn't get a chance to meet you at the last conference, hopefully they'll get.
Don't mind Miami, so we'll be there. We'll be there.
Wonderful. All right, thank you all. Thank you everybody for participating. Happy Thanksgiving, everybody, and appreciate you all being on the call, and look forward to doing more like these. So take care, everyone.